Hello and welcome everyone for another market commentary from StashAway. The markets have been very volatile over the last week, right?
Yes.
Especially the last couple of days as well. So we felt it should be another video from us to you. We're getting a lot of questions. People are obviously also concerned, right? The market has been very turbulent and the events are kind of still unfolding. So we felt like it would be a good idea to have Freddy, our Chief Investment Officer, give a little more insight on actually what's happening, what you kind of foresee as well. So given what I just said, volatility is spiking, right, in the global markets. Can you give us a quick overview of what happened the last few days, and then also what are the factors behind that?
Right. I mean, we have a backdrop of the coronavirus going more global. We've seen Italy in lockdown now, and Germany's next. And the US had a travel ban that's a little bit ill-conceived, right? So we started the week first against the background of the coronavirus, and we have a nasty oil shock. As you know, on Monday, the markets have to confront the breakdown in the production agreements between Russia and Saudi Arabia, and now we're in a price war where oil prices are falling like hotcakes. Yes. And it triggered a sudden contagion in terms of credit, where there are concerns about regional banks in the US having extended loans to shale gas companies that's now suffering. So there's a lot of this chain reaction that's starting to show up in the markets, and the turbulences is certainly justified, right? And that's made worse by Donald Trump choking on air.
Yes.
Was that 2 days ago?
Yes, I think it's been analyzed by every news outlet so far, right?
I would say he choked on air because he promised big actions. Instead, I think he got spooked personally because he was on Air Force One and there was a staff who contracted the coronavirus. And then he hastily reacted to it by, at such a late time, people have told him before, but at such a late time, he implemented this travel ban from Europe to US. What makes it worse is that he also quoted facts wrongly.
Correct.
At some point,
apparently there was some changes that he made 5 minutes before the presentation again.
He said things about international trade would now be halted. That's not true.
Correct.
It's just about people who travel to Europe. Yes. They should not come back for 14 days. Yes. So there's a lot of wrong facts that he certainly cracked under pressure, and he said a sort of misinformed in his presentation.
And I think that also helps people not have any confidence, right? Because you want to have a leader with, hey, I'm confident, say X, Y, Z, right? This is what we're going to do.
Yes, but having seen what I've seen since last night and this morning, we'll go into that more later. Yeah. Lots of upswings and downswings, not just downswings now. Yeah. The Fed last night has provided massive amount of liquidity. Around 500 billion a week in repo operation, another 500 billion with a 1 month maturity, another 500 billion with 3 months maturity, and they have capacity to go as far as $5 trillion. And central banks around the world are starting to join in the chorus. Yes. The bazooka is coming.
So, bazooka, good word, right? But what do you mean by that?
Well, it was a term used back in 2008 in the financial market industry, where they refers to Mario Draghi's quantitative easing program. Actually not about the Fed, but it's more about ECB's program back then. Because Mr. Mario is Super Mario. He's like, whatever it takes. So that's called a bazooka. But this time, by bazookas, I mean two things. Okay. First, already ample evidence since this morning. Japan, Australia, all the central banks are able to be quicker than governments, and they can coordinate and they can really do stimulus, and they are all doing it now. Yeah. And two, governments around the world have a rude awakening this week. They were too complacent. It was from blaming the Chinese for the virus to being a little bit complacent, downplaying the necessity of lockdowns or all the necessary testing measures. Correct. Right? They have underinvested in their testing frequencies, totally unprepared for it, and New York now is responding in emergency mode, right?
And I think you got celebrities,
Tom
leaders of the world.
Hanks.
No, but I think it's woke up people. It's like, oh, it's not anymore that far away, right? It's like public.
Tom Hanks and wife got it.
Yeah.
Justin Trudeau's a Canadian Prime Minister's wife has got it, and he's in quarantine now. There's sort of a rude awakening to people that this is getting really personal. It's right around you. And so governments are now swiftly talking about rescue, support packages to ease the pain, because they know that they will have to implement some form of freeze or lockdown like the Chinese to contain the virus, and they know that they cannot do so without support packages now.
Right, because people still have to, pay rent. They can't take, in the US especially with the sick leave, right?
Yes.
A big problem, right? So hopefully the Republicans and Democrats can come together here and
as far as I knew last night, the House Democrats have, to the irony of Donald Trump's performance, he's looking really bad right now, because House Democrats have got a much more comprehensive plan that includes paid sick leaves. Paid sick leaves is really, really important, because imagine if you're a worker, you have to choose between making a living and you're sick, or not going to work, not making a living. You would go to work and spread the disease.
100%, yeah.
So the effectiveness, the thoughtfulness of the plan is more on the Democrat side now. However, there's a lot of disagreement about who is going to pay for the paid sick leave budget. The Democrats think that corporates should pay it and they should get a tax credit for it later, whereas the Republicans, in principle, they are disagreeing to this because they tend to be more business friendly. So apparently tonight is another critical meeting between Pelosi and the rest of the White House to work out this package. So we're going to stay tuned on that. But the main point is that governments are really, really waking up to it. And it's not just Japan or South Korea, it's Germany, Italy. I have to say Italy has got, 4 budget increases in 1 month? European Union has very strict budget spending rules that's out the window to fight the coronavirus.
It's all hands on deck now.
So by bazooka, the second one, I mean global governments, not just a central bank.
Not the monetary government stimulus.
And they're going to come in together to fight this.
Yeah, absolutely. So thanks for that, Freddy. I think that those are valid points, right? And what's going to probably play out here. But moving away from the bazookas, right? There is actually, right, and we talked about this before, some positive developments as well, right? So it's not all just dark clouds and craziness. Can you maybe elaborate a little bit on that?
Yes, I think we can start by having this. The moment when you have Italy in focus, it goes global. So markets completely just focus on the numbers over there. But what they've noticed, China has made great progress. The number of recovery rates are massively far surpass the number of new infections and new deaths. And as you've seen, according to WeBank's big data analytics, where the indicator is called a CERI, the Chinese Economic Recovery Index, it measures, is a GDP weighted by city. Each city has a GDP, so they weighted by the city's GDP share of GDP in China, and each city's through telecommunications, mobile networks, how much mobility are people having now? And the number was 21 to 27% in 1st February. It's gone up to 36% as an average for February, and as of now, 70%.
Wow. Okay.
So China has told the lockdown has
worked, right?
Yes, and anecdotally, you've seen the likes of Apple. They have reopened. I used to say 29 out of 42 stores. As of now, all of the stores have reopened in China. So the markets have just been very focused on the other parts where they're still escalating.
Correct.
And so what we believe will happen is the moment the similar measures have been implemented in Italy, Germany, and US, as soon as somebody shows similar progress in China, just even a little bit of trend, that will really, really provide, turn the attention over back to the progress.
The market just needs to see a little bit of that good news, right?
Yes.
Is it working in certain parts? And then we kind of will probably see some reversal here. So obviously we're clearly moving beyond typical correction, right? So what can we learn from past crashes?
Well, crashes are a form of correction, but it's just much more, it's bigger. It's similarly quick and speedy, and it has a lot of whipsaws. In a crash, everything is just escalated to a level that's much faster. It's unpredictable. You can prepare for it, but you cannot react to it.
Yes.
Because in all cases that we study, whether it's 1987 October's crash, or whether it's the fresh crash of October 2015 in the treasury markets, or even 2008, when we see a lot of big drawdowns during the Lehman shock period, there's one lesson to be learned is that the whipsaw kills investors who react to it. So instead, we should turn the question around and say, can we, in our financial plans, prepare for it? So I think at StashAway, the way we do it is to estimate stress risk index rather than a normal type risk indices. And so I'm happy to say that the StashAway risk budgets, you're far from reaching it. Even with the unprecedented moves that we have seen since the last 25 years.
And maybe you can explain a little bit more of that, right? Because I think this is exactly why we built it that way, right? So, and why you should be looking at your risk index and what you're comfortable with, right? And you want to explain
because a common problem in industry is that people have a look-back window to look at volatility and risk estimates. The problem is that when you are looking back at good times, you are always going to underestimate the extent of the moves when the storm hits. It's called a calm before the storm effect. StashAway addresses this by not looking back arbitrarily. Instead, we look at the whole history. We take slices of the data that correspond to stress scenarios. In fact, we rank them by the top 10 pain scenarios. 2008 global financial crisis. If it happens tomorrow, what's the instantaneous shock to your portfolio? And then what's the second largest pain point? What's the third? What's the fourth? All the way to the 10th. And our risk indices is designed to capture a majority of those scenarios. And I'm happy to say that as of now, although users may see the short-term drawdowns, I'm very happy to say that we are very, very far away from reaching close to anywhere near those risk budgets.
Correct, and I think that's very important to understand, right? Because it doesn't seem like that from the, you know, when you first look at it, or like you're not as familiar with that kind of measuring. Let's move on a little bit from that. You obviously, same on my end a little bit, but you talk to a lot of high net worth investors and investors in general, right, on a daily basis. What are you kind of getting from them? What are the conversations like? What are they doing? How are they feeling about this?
Yeah, I have the fortunate position that where I came from. Professionals, fund managers are still talking to me. And our clients, high net worth and ultras or not, a lot of people have been reaching out over the last 3 weeks. And the common theme I have, the observation is this. For the savvier and experienced investors, and also the more higher net worths, the questions are not capitulation. In fact, the questions were, should they be moving their risk point from a low to medium to a high risk portfolio to capitalize on the valuations? Or some of them are eager to accelerate their investment plan and contribute more now. My response to these two tendencies have been less exciting for them. On the first point, I believe that they should not hastily change their risk level, which is budgeted based on their goals and plans. They should not change that. It's just out of the window because it's a market condition, right? You have a long-term goal. That's 30 years there. Why do you care about the next 2 months or next 1 year what's happening? You are systematically saving every month and you're contributing it. So that really should not change. But if there's a good reason to change it, I would still advise them to do it in a staged process because we have studied the virus impact and on market in the past, and we have seen the clock on the market can be anywhere between 2 months or 5 months, longer, shorter. Honestly, who knows?
Who knows? Yes, exactly.
The thing is that you use a data or a rented approach to study it, and the conclusion is that you should not be hasty in accelerating your contributions or changing your risk level now. And you should, if you want to do so, please do so in a dollar cost average manner. You can do it over the next 8 weeks, or if you are more pessimistic than most of the clients that I've talked to, you can do it over the next 4 months. Because we started the clock on 19 February, HIV was 5.1 months from 19 February, that's the clock. And 2 months for all the other pandemics from then. Again, based on data, not fortune telling. In any case, do not be hasty.
Yes, thank you, Freddy. So to wrap it up, is there any other advice that you want to give the audience before we break it off?
Really, I think in principle, risk management, risk budgeting has to be done from day one before you invest. That's what we always preach. It remains even more so in these market conditions. If you haven't hit your risk budgeting, why should you react? Stick with a long-term investment plans. Even if in the future, whatever economic conditions, right? I mean, you have budgeted and planned for it. Stay with it.
Yeah.
If you're nervous, revisit your risk level. Or maybe you have done too much lump sum, revisit those plans. And just the one thing you need to remember is that don't get KO by the markets. Yes. Staying invested is a fundamental assumption of all investment models, including the famous Nobel Prize winning, what is that, the modern portfolio theory. They all assume that you invest, stay invested and reinvest, and then you realize those long-term gains. There's a reason why you're getting paid returns. It's because the price of that is you're enduring the ups and downs of markets. And that's where we are much more focused on doing. And so today my advice is the same. Don't get KO by the market. Stay invested. Review your risk level. These fundamentals do not change.
Correct. And I think even Warren Buffett said your holding period should be forever, right?
Yes,
so
absolutely.
Kind of wraps this up as well. So thank you very much for listening. Thank you, Freddy, for giving us all these insights. I hope they were really helpful for our audience, which I'm sure they are. If you do have any additional questions, feel free to put them in the comment section below. Also, if you have more specific questions, feel free to reach out to us. Our client engagement team is there for you. You can email us, WhatsApp us, give us a call. Either way, we'll be with you again over the next week. And other than that, stay calm, stay safe, and ciao. Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.